Hi, Scott Smith here. Today we're going to talk about joint ventures and how they can be beneficial to you as an investor and how to structure them so that both parties in transactions are profitable. Now, joint ventures are usually structured on a 50-50 basis so that you share equally in the profits. One of the ways you can structure the joint venture is that for you bringing the deal to the table, you may only have to come up with 25% of the amount of funds needed to put down, whereas they would come up with 75% in the amounts needed to put down. So for the purpose of analysis today, we are assuming a 50-50 joint venture partnership. They bring 75% of the amount down to the table. You bring 25% of the amount down to the table. And we're going to look at a $2 million deal that's on the market at a 7% cap, which is $140,000 net operating income. 2 million, 7% cap, 140,000. Now your debt coverage ratio at 1.25% means that the maximum loan amount that you can get on this property is $1,380,000. Assuming that you're at a 6.5% interest rate with a 25-year fully amortized term with 0 points. Okay? 0 points. Your monthly payment is going to be $9,317.86. $9,317.86. Okay. So the remaining balance between the 138 loan amount is $620,000 needed to put down on this investment. But you're structuring it with the 75% that your partner comes to the table with, and you're coming to the table with 25% of this figure. So they would come up with $465,000. You would come up with $155,000. Everybody see that? Excellent. Okay. Now, let's say that this property is increasing in value at 3% compounded annually. So at the end of year 5, your property is worth $2,318,547. Okay? And your loan amount due at the end of year 5 is $1,370,685. Let's say that you have to cash them out because they want their money back at the end of year 5. You pay a 10% closing. Your sales proceeds would be $716,000, $7.41. That is your sales proceeds before tax. But remember that you still have to put back that $620,000 for the amount down, of which you paid $155,000. So your sales proceeds before tax would be $96,007. Divided by 2 is $48,000. And you're probably thinking, well, why would I want to invest $155,000 and only get back $48,000. Not a bad return, but still seems kind of low. Well, here's the thing that we did not include. Remember that your NOI is $140,000, right? But your annual payments were $111,814. So that still leaves you with, at the end of year 5, $140,925. If you divide that by 2, is $70,462. Plus your sales proceeds of $48,000 brings your total return on your investment to $118,462. That is not a bad return on your dollars when you're investing $155,000. You get all of that back in 5 years, plus $118,462. All by bringing in a partner that comes up and puts down the $465,000. They're also receiving all of their funds back and $118,462. That is how joint ventures work. Obviously, you can see the benefits as to why bringing a joint venture would be beneficial. You can still have $300,000 to put into another investment, maybe do, 2 more of these, and then you would have, $350,000 in 5 years off of a $620,000 investment. If you have any questions, feel free to contact me at Spidey Real Estate. That is SPIDEY Real Estate at yahoo.com. My cell number is 443-691-8153. Thanks.